Cathie Wood, everyone will be terrified. Hello viewers, welcome to my YouTube channel. Today in this video we will talk about Cathie Wood, everyone will be terrified. However, before we start our countdown, we would appreciate it if you would subscribe to our YouTube channel and also press the bell icon. So, let's get started. Undeterred by the market sell-off this year, ARK Invest founder and CEO Cathie Wood doubled down on disruptive innovation stocks and predicted deflationary trends will continue into next year. Non-farm and payroll employment was roughly in line with consensus expectations, up 315,000. Household employment was up, more than 400,000. Now, we pay more attention actually to the household. If you look at household employment, it flattened out and actually went down from March until this month. And so from March through August, effectively it's been flat with this latest 400,000, but if you look inside the 440,000, what you're going to find is that's all part-time, much lower paying jobs. Full-time employment is down, and so that's a problem for the economy. It suggests stress is in strains, more people having to work two jobs to make ends meet and pay for food, and energy. And what's also interesting is if you look at the gap between the non-farm payroll employment number that seems to have been charging ahead and the household employment number that's gone flat. That's 1.6 million people right there. So there's a huge discrepancy between those two measures of employment, and the household employment measure includes many smaller businesses, and they often react much more quickly to changes in the economy than do large corporations, which are captured more by non-farm payroll. But some cracks in this report, seasonal factors aside. The unemployment rate did go up from 3.5 to 3.7%. We did have an increase in the participation rate in the labor force, so that certainly is one reason for it. The average hourly earnings were up 0.3%. We now know that they peaked on a year-over-year basis at 5.6% in March. March is an important month here. It seems like a lot of things peaked back then, now we're down to 5.2%. And still that's a huge loss of purchasing power, because inflation during this time was up 8.5%, so more than a 3% loss of purchasing power on a year-over-year basis. The other thing we saw was the average work week tick down. Most people do not pay attention to this number. It just changes by a tenth or two per month, up or down, but it often has an outsized, on average, weekly earnings. So those are even worse because hours have ticked down. The other thing to note is that the Challenger survey, which measures layoffs, broad-based layoffs, those are up 30% year-over-year. This is what I mean. We're seeing all of these headlines and the Challenger survey suggests they are real, and yet we're not seeing it in the employment report. Initial claims, as I mentioned, having spiked at the most rapid rate going into a recession that we had seen, now seem to be settling down. And that's got me wondering about this seasonal factor. The other employment-related number that came out this week was JOLTS job openings. So this skill set mismatch or companies not paying enough to attract labor is still impacting the job openings. The number of opening, I think steady state. They used to be 2 to 3 million and now we're up to more than 11 million in terms of other economic indicators. Retail sales in the latest month and personal consumption expenditures both flat. And this is in real terms. And auto sales, and I pay a lot of attention to auto sales. It's a big ticket item. And at a steady state, they're usually 17.5 million units, at an annualized rate here in the United States. So we know because of chip shortages that they were very depressed for a long time. So one would have. Pent-up demand was increasing. Well, the chips are chip availability clearly is easing, and yet auto sales dropped from 13.3. Remember I said steady state is 17.5 and we haven't been there in a long time. They dropped slightly to 13.2 and they probably moved up more because of electric vehicles. Certainly more because electric vehicles are booming and traditional gas-powered car sales are floundering. So this is a big problem for the auto manufacturers. The 90 to 95% of their sales are still gas-powered. And so it was curious for us to see GM reinstate its dividend. I think that was Mary Barr's way of showing confidence that they'll be able to transition into the electric vehicle pretty well. But I don't know. This is a very big shift. Housing is in some ways in free fall. There's a lot of negative sentiment. Housing starts dropped roughly 10% last month. Permits down 1.3. The National Association of Home Builders haven't been this negative since the 08-09. Existing home sales down 6% in July. New home sales down nearly 13%, and that's month to month. If you were to annualize that, you'd get a sense of almost free fall in the housing market. That's what, close to 6% mortgage rates will do. And it's happening. Housing has a very big multiplier out there. A lot of other industries are dependent on it. So, we don't take it lightly. Consumer sentiment did bounce a bit. Boy, the market's around with that. But the bounce was related to gasoline prices coming down, which is great. but it got us to the low points basically that we hit in 809. So in other words, we were record lows. It got us back to the low points hit in 09, 80809, and in 1980. 81 when inflation and interest rates were in the double digits and Paraman Volcker was being very tough. From a monetary policy point of view, we also know that the consumer saving rate has dropped to 5%. Now it was in the, I can't remember the exact number, but I think in the spike it went to somewhere in 20% when no one could spend any money during the early days of COVID. Now we're down to 5%. We haven't been that low since, I believe 2009-10. So a lot of people are using this. Hey, because of all the stimulus out there during COVID, there's still $3 trillion worth of a buffer. You know, you can make that same statement when you're talking about consumer worth. Consumer net worth is $130 trillion. What that means is assets. So stocks, bonds, houses, and other longer-lived durables like cars, minus liabilities, how much we owe. And that's 130 trillion. And that's been going up regularly. It gets knocked during recessions. It's being knocked a bit right now, but that's a huge buffer too. So I think that, and that narrative seems to be making the rounds and fueling this idea that the consumer's going to continue to spend. Well, if you look at good spending, the consumer in real terms, the consumption of goods is down and has been falling for the past year, and it's still above the trend that was in place pre-COVID. And the inventories are massive. Nancy Lazar at Piper does seasonal adjustment of company inventories. And if you look at Walmart, again, one of the best managed companies in the world, its inventories in the July quarter did not go down, and we had already said, my gosh, they're swimming in inventories. So I think they're going to have to start slashing prices to get the consumer to bite onto inflation. And as part of the economic indicators, got a lot of reinforcement. The Fed did from the headline numbers, which again may be distorted one way or the other. PCE deflator, which the Fed pays most attention to, this down 0.1% month to month in July. So that's deflation, the core rate, which they pay more attention to. Again, taking out food and energy. As I mentioned before, it was up 0.1% and has dropped from 5.3% in March to 4.6%. Again, they're looking at 2% vis-a-vis that number. So 4.6% to 2%. So this was our today's video. I hope you all like this video. Don't forget to hit the like button and subscribe my channel. And also share it with your friends and family. We will be back soon with a new video. Till then, keep supporting and take care.